Like getting great deals on great merchandise? Want to be invested alongside Warren Buffett? Looking for higher yields on dividend growth stocks that have seen their prices collapse? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, if you want exclusive access to my personal six-figure stock portfolio and alerts on any new investments I make, check out the Patreon link in the description below. 2023 is off to a pretty good start for the market. The S&P 500 is up by 4.5% as I shoot this video. After a disastrous 2022, that's promising. However, it's a market of stocks, not a stock market. The stock market isn't a monolith. The S&P 500 is comprised of, you guessed it, about 500 different stocks. They don't all move in lockstep. Indeed, some of these stocks are down heavily from their recent highs. And for those still in accumulation mode and buying, that's a good thing. After all, price and yield are inversely correlated. All else equal, a lower price results in a higher yield. And if your goal is to live off of totally passive dividend income like I do, that gets you to your goal that much faster. Today, I want to tell you about 5 dividend growth stocks that are down 20% or more from their recent highs. Ready? Let's dig in. The first dividend growth stock I want to bring up is Baxter International Inc., stock ticker BAX. Baxter is a multinational healthcare company with a market cap of $23 billion. Baxter's products primarily focus on treating kidney disease and other chronic and acute medical conditions. What's great about healthcare, and why I love investing in great healthcare businesses, is the secular growth. If you need medical care, things like geopolitics with China, the strength of the dollar, or whether or not the US is in recession, these things just don't matter to you. The global population is growing, and with that comes ever more human beings that will need medical care over their lifetimes. Plus, people are living longer than ever before, and on a global average, we're richer than ever before. All of this adds up to more healthcare spending, which then adds up to increasing dividends for those companies benefiting from that. The healthcare company has increased its dividend for 6 consecutive years. Now, Baxter's dividend growth track record isn't as long as it ought to be, and that's because this company was involved in a major corporate split a number of years ago. Baxter is mainly the medical devices portion of what was the legacy company, whereas the biopharmaceutical side was spun off into what ultimately became Baxter International Inc., which itself later got bought out. If not for that separation, Baxter would almost surely have a much longer dividend growth track record. Still, we've got a 5-year dividend growth rate of 14.5%, which is great, although more recent dividend raises have been in the single-digit percentages. The stock also yields 2.6%, which is 140 basis points higher than its own 5-year average. And the payout ratio is only 32.5% based on current midpoint guidance for full-year adjusted earnings per share. This stock is down, are you ready? 50% from its 52-week high. Now, if you bought the stock at its 52-week high of $89.70, that's a bummer. But for those looking to buy in now, the current pricing of about $45 on the stock sure looks a lot better on a go-forward basis. Based on that guidance I just mentioned, the forward PE ratio is only 12.6. The price to cash flow ratio of 15.4 is well off of its own 5-year average of 20.2. In my view, Baxter is interesting here. The company has had some missteps, especially in regard to M&A, but structurally, it's a great business model in one of the best areas of the whole economy. I think Baxter is very much worth looking at closely after the stunning 50% fall. The second dividend growth stock we have to go over is Best Buy Co. Inc., stock ticker BBY. Best Buy is a North American consumer electronics and appliances company with a market cap of $19 billion. I've got to say, Best Buy has really surprised me. If you would have asked me even just 5 years ago, I would have guessed that this business would be troubled by now. Nope. This retailer hasn't just been surviving, Best Buy has been thriving. Despite a retail graveyard all around the business, Best Buy has been growing its top line and bottom line admirably. And with the omni-channel strategy clearly in a groove, Best Buy's best days look to be ahead of it. That bodes well for the continued growth across the business, which should translate over to the dividend. The retailer has increased its dividend for 19 consecutive years. Almost 20 straight years of ever higher dividend payments. Considering how difficult and competitive retailing has been, that's impressive. If that doesn't show how resilient the business is, I'm not sure what will. The 10-year dividend growth rate is 17.8%. Along with that double-digit dividend growth, the stock offers a compelling 4.1% yield. I get it, there is some risk here. It's not something that you bet the whole farm on, but it seems to me like a 4% plus yield and double-digit dividend growth rate is compensating you for some of that risk. Meantime, the payout ratio of 52.5% reveals a healthy dividend set for more growth. This stock's 24% drop from its 52-week high has created a more favorable entry point, in my view. This was a $112.96 stock at its 52-week high. Now, it's priced at below $86, and buying it 24% cheaper than it was obviously sets you up for better long-term returns from here. The price-earnings ratio on the stock is at only 12.8, which is very undemanding. Not that the stock ever really commands a super demanding premium, but its 5-year average PE ratio is 14.4, so we're below even those modest levels. We last analyzed and valued the business back in July, estimating intrinsic value at $105.70 per share. At the 52-week high, it looked overpriced, but the pendulum has swung very far to the other side and it now looks underpriced. Low expectations, a 4% plus yield, and double-digit dividend growth. There's a lot to like here. The third dividend growth stock we should quickly discuss is Celanese Corporation, stock ticker CE. Celanese is a chemical and specialty materials company with a market cap of $13 billion. Celanese flies under the radar, doesn't get a lot of love or attention. Or does it? It sure has caught the attention of Warren Buffett's firm, Berkshire Hathaway Inc., stock ticker BRK.B. Berkshire Hathaway initiated a position in Celanese in Q1 2022, which they have since added to, and we quickly highlighted this in a video back in the summer. I can see why Buffett's firm likes it. Celanese grows the business like clockwork. It's been super consistent with revenue and earnings per share growth, and Buffett has a well-known affinity for growing dividends. Well, Celanese also grows its dividend like clockwork. The chemical company has increased its dividend for 14 consecutive years. The 10-year dividend growth rate of 26.7% is super strong, but there has been quite a bit of deceleration in the dividend growth. For instance, the most recent dividend raise came in at only 2.9%. So that is a bit disappointing. On the other hand, the stock's yield of 2.3% is 20 basis points higher than its own 5-year average. The yield has been rising a bit in order to counterbalance the slowing dividend growth, and the payout ratio is only 18.6%. Celanese is having no issue whatsoever with the dividend. It's easily affordable for the company. This Buffett-owned stock has seen its price drop by 30% from its 52-week high. When you look at when Berkshire Hathaway was buying Celanese, the shares are now priced lower than that, so you can get in at a cheaper level than the Oracle of Omaha. That's exciting. In fact, the stock hit its 52-week high of $173.95 back in Q1 2022, which is when Berkshire Hathaway was doing a lot of the buying. The stock is now priced at right about $121. That's a hefty drop. And what it's done is it's compressed a lot of multiples. Earnings are higher than usual right now, but every multiple is lower than its respective recent historical average. If we drill down into sales, the price to sales ratio of 1.4 is well off of its own 5-year average of 2.1. If you like the idea of being invested alongside Warren Buffett, but you want an even better deal than Buffett's firm got, Celanese is worth a good look. Fourth up, we've got to quickly talk about Kroger Co., stock ticker KR. Kroger is an American supermarket chain with a market cap of $32 billion. Super simple business model here. We're basically talking about grocery stores. It's competitive and the margins are thin, but if a company can do it right, there's a lot of money to be made here at scale. And Kroger has definitely mastered the scale game. Annual revenues are well over $100 billion now. And with inflation rising and wallets getting pinched, any potential trade down to eating at home, which requires more groceries, bodes well for Kroger. That also bodes well for the dividend, which continues to grow at a high rate. The supermarket company has increased its dividend for 16 consecutive years. Like I said, the dividend has been growing at a high rate. How high? Well, the 10-year dividend growth rate is 14.5%. Think that's pretty good? It gets better. There's been an acceleration in dividend growth with the 3-year dividend growth rate at 15.4%. And the most recent dividend raise came in at a monstrous 23.8%. Also, the stock yields 2.3%, which is 30 basis points higher than its own 5-year average. Even after all of the double-digit dividend growth, the payout ratio remains a very low 25.4% based on full-year adjusted earnings per share guidance at the midpoint. This stock's 28% drop from its recent high has basically brought it back down into fairly valued territory. At the 52-week high of $62.78, the stock looked overpriced, just way too expensive at that level. Shares are now trading hands for about $45 each, and I think that's a fair deal. Kroger's net margin is running below 2%, so you really have to be mindful about valuation with this one. The collapse in pricing has compressed every multiple, including the price-earnings ratio. That ratio is now at 14.2, which is right there with its own 5-year average of 14.4. The price-to-sales ratio of 0.2 is dead on with its own 5-year average. Now, these multiples are undemanding, but with the razor-thin margins, they should be. By the way, Warren Buffett's Berkshire Hathaway owns a stake in Kroger worth about $2.3 billion. I think now would be a good time to consider joining Buffett on this one. Last but not least, I want to highlight Tyson Foods Inc., stock ticker TSN. Tyson Foods is one of the world's largest processors and marketers of chicken, beef, and pork, with a market cap of $23 billion. You don't need much of an imagination in order to invest in Tyson Foods. You don't need to take a giant leap of faith. I mean, this is a company providing food, and we've all got to eat. Moving past the basic necessity of eating, most people want to eat the best food they can get their hands on, and that often leads straight to proteins. The proteins that Tyson Foods is providing to the world. Betting on Tyson Foods is essentially betting on people's continued demand for proteins. That's been a good bet for a long time already, and I think it'll be a good bet for a long time to come. This easy bet should also lead to plenty of rising dividends. The food company has increased its dividend for 12 consecutive years. Tyson Foods has balanced dividend metrics that offer something for everyone. Want a market-beating yield? Okay, the stock yields 3%. Want inflation-beating dividend growth? Okay, the 10-year dividend growth rate is 27.7%, although more recent dividend raises have been quite a bit lower than that. Want a safe payout ratio? Okay, it's at just 21.5%. It's tough to complain about any of this. This stock's 35% slide from its 52-week high has created what I think is significant undervaluation. Look, I'll be honest, Tyson Foods doesn't necessarily wow me in any one area. Instead, it's just a really good business across the board. But what does wow me is the valuation, which has become about as favorable as I've ever seen it after the collapse in the stock's price. When the stock was priced at its 52-week high of $100.72, that was a hard pass for me personally, but down here at the $65 area, I think it's a compelling idea for long-term dividend growth investors. Our recent full analysis and valuation video on the business estimated its intrinsic value at almost $82 per share. If you haven't already, give Tyson Foods a good look here. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these 5 dividend growth stocks that are down 20% or more from their 52-week highs. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.